Rising interest rates, of course, make it harder for people to obtain a credit. And, of course, we did see tightening up in the United States after the failure of some banks. We have seen losses for some financial institutions, stocks, inflation, of course, raising questions about how strong the economy is going to be. We're joined now by the boss of a financial tech company that uses artificial intelligence to assess credit scores for underserved customers. The company is expanding in Canada. It started off in the United States. Let's get more on this AI technology. We're joined by Clive Kinross, CEO of Propel Holdings. It's great to see you.
Yeah, great to be here as well. Thanks for having me.
So you trade on the TSX PRL. You got your start in the United States, but where's the company's head office? Where are you based?
The company's head office is here in Toronto. We started the business about 12 years ago. In fact, we're about to celebrate our 12-year anniversary. We've got about 425 employees, the majority of whom are here in Toronto with a small satellite office in Winnipeg. And what we do is we provide unsecured loans through our financial technology to underserved and underbanked consumers. Unsecured.
Because obviously there's been huge growth in these home-based lines of credit, but you're dealing with customers, in many cases, who don't own a home?
Well, many of our customers do own a home, but either they can't tap into the equity in their homes, or alternatively, the data in the United States and Canada, respectively, about 37% of the US population cannot afford $400 in the case of an emergency expense. That's up from about 33% in 2019. In Canada, about 54% of the population lives paycheck to paycheck. And in your opening comments, you remarked how banks have tightened up in their underwriting. That's absolutely the case. And as a result of that, consumers who might otherwise be able to obtain a small dollar unsecured loan through a bank are not able to. So our segment of the market is growing as more and more of those turndowns come to us for their loans.
So these tend to be people with a lower income?
I think that they are more like your everyday Americans and your everyday Canadians. These are folks with an average income of the $40,000 to $60,000 range. I would say to you that the incomes and the credit scores that we were seeing pre-COVID were lower than what they are today, meaning incomes that we're seeing today and credit scores that we're seeing today are better than they were pre-COVID. And if you said to me, Andrew, what's the reason for that? There's been tightening all the way through the credit supply chain. Banks and credit unions have got a risk-off approach right now, partially because of nervousness with the economic environment, as well as a rising interest rate environment, and consumers who otherwise might get a loan from them are being pushed to us. And my concern is more and more of middle America and middle Canada are being forced down to higher rates, less ideal products, at a time when rates are escalating.
That's an interesting story. We don't have time to go into it altogether, but it's very interesting. What would your rates top out at? Give us a benchmark.
In Canada, the maximum rate is 47%. So our rates in Canada go from 19.9 to 47%. In the US, there is no federal rate. So as a result of that, different states have different rates. But again, we are targeting unsecured consumers, small dollar loans, and that's why our rates are where they are.
Those are high rates. I mean, what if somebody said to you, you're taking advantage of people?
I would say to them that they don't understand the economics of the business model. You know, at the end of the day, if a customer in Canada came to us for a $1,500 loan, and they paid us back a month later, they would pay us back the $1,500 plus about $53. Find me a business anywhere in the world that sells a product today for $1,500 and a month from now gets back $1,553 with a 53 margin to risky consumers. The low-cost retailer in the world is Walmart. Walmart mark up their products by about 30%. They sell them roughly a week later. If they put the APR label on every product they sell, the APR will be about 1,500%. In the financial world, we are obligated to put the APR on our products, which is why it might look like it's high, but when you think of it in those terms, as well as the costs associated with writing our loans, you would see that it's more than reasonable. And in fact, rates in Canada of the G7 countries at 47% are the lowest across the board.
I mean, it is a very different model from typical banks. I see your charge-offs in the latest quarter were something like 12%. I mean, those are provisions for loans that you think you might not get back. So, I mean, that's a high level compared to a bank.
They're risky consumers. So as a result of that, the default rates do tend to be higher. It is higher than what the banks would charge. And again, the banks have a risk-off approach. At the end of the day, the banks aren't lending to these consumers. A, they don't have the AI infrastructure and know-how to be able to lend to them. As a result of that, there's 6 banks in Canada, and they make all their money all day long without taking risk, so they don't need to open up their market to these consumers.
It's an interesting social policy question that these consumers are not getting access to the financial system, but we're so tight on time. Tell us more about this artificial intelligence.
Yeah, no, I appreciate it. There's lots of different avenues that we could go. And just speaking of the banks use traditional scores to do their underwriting, and traditional scores, in the context of traditional scores, it could be a FICO score, which are very, very effective at underwriting and providing loans to super prime or prime consumers. Don't work that well for underbanked or underserved consumers, and we can't really use a traditional score for these consumers either. They don't tell us enough information. So somebody may have lost their job a few years ago, defaulted on a car loan, missed a couple of payments on their credit card. As a result of that, their traditional credit profile really doesn't look good and they cannot get access to a loan. When we look at their information, we're looking at way more data points for the consumer. We do look at their traditional credit score, but we'll look at other data points like how long have they had their email address, how long have they had their cell phone, what is their email address. We'll look at traditional variables like income, how long they've been employed, and so on and so forth. And what our machine learning model does is it takes all of these variables about a consumer, forms a more current context about them. We are then able to apply a score to the consumer and decide whether they qualify or not. Andrew, we look at about 40,000 applications each and every day, and we wouldn't be able to do that and score these consumers if we didn't have the AI backbone to our proprietary technology.
That's interesting stuff. So your yield, roughly 4.9%. I see the stock is down a bit in the past year, but the dividends has kept people on side.
Look, our investors keep telling us all the time that the stock's undervalued, and I say to them, why do you think the stock's undervalued? I'd rather hear from them than from me. And they say to me, Clive, this is a company that about 5 years ago was doing 60 million US a year in revenues. We went public in 2021. That year we did 130 million US in revenues, made 7 million in profits. This year we're on track to do 330 million in revenues with 30 million in profits. We've increased our dividend. So when they look at all of this, they say they have never seen a fintech growing the way we are, being profitable the way we are, and they believe we're undervalued.
That's a fascinating story, Clive. Thank you very much.
Thank you so much, Andrew.
Clive Kinross.